joining in. We are at a very interesting juncture when it comes to the market, be it our own or be it the global markets as well. Because of the fact that there are so many moving parts, right? We are still awaiting clarity on the trade deal with the US, which is likely to happen based on what the US president has said by the 1st of August. We still don't know the contours of that. We are in the middle of an earnings season that has so far flattered to deceive. It's not been the most impressive start to the earnings season. Do you see the valuations to be justified considering the fact that the macros so far have been relatively stable?
Hi, thanks for hosting me. A lot of questions packed into that, so let me take it one by one. In terms of the weak earnings season, yes, we anticipate a weak earnings season in this first quarter. While we are constructive on an economic recovery in FY26, we think it's going to be back-ended, and most of the earnings growth will come in the second half of this year. So from a medium-term perspective, the weak earnings season shouldn't matter. We don't think that there will be major earnings downgrades on the back of this weak season. But in terms of a near-term impulse, this is undoubtedly a negative. Secondly, on valuations, the 10% rally in the Nifty in the first quarter of this financial year has taken a lot of the valuation comfort out. We wouldn't say that valuations are in bubble territory. They are neutral. Most of the indices are trading at between long-term averages and +1 standard deviation. So that's not alarming, but it's not really comfortable for it. What we are saying is that from here, stock performance will be driven more by earnings growth rather than re-rating. The re-rating has done its heavy lifting in this last 3 months. And from here on, earnings growth and earnings upgrades will be the key driver for the market. So, and the other factor, the point that we are making is that in the short term, for the next month or 2 or 3, the markets are likely to mark time because, as you correctly pointed out, there are other moving parts as well. The trade deal will come through, and the full impact of that, I think, can only be assessed once it's announced. There are too many moving parts in that. And the impact of the monetary easing, what we expect it to come through strongly in the second half, is not visible yet. And near-term macro indicators are also sort of iffy. Growth numbers, monetary transmission numbers are, if you look at concurrent numbers, they are not very constructive. So our belief is that after this strong rally, you will see a little bit of a pause in the markets. And if we are right on our overall macro thesis that the rate cuts will translate into a consumption-led revival in growth in the second half, then you will see the next leg of market performance come in at that point.
Okay. Seshadri, I wanted to get your point on what's happening with the primary market. Suddenly there's a flurry of IPOs. What does that indicate? Does that indicate that there is a froth now? Or do you think this is something which can indicate positive market sentiment as well?
For a longer-term perspective, I firmly believe that IPOs are good for the market. They help widen the universe. They help absorb flows and avoid bubbles getting created. One of the reasons why we are not into bubble territory yet is because despite very strong flows from both domestic and international investors, there's been enough supply to absorb some of that. And so from a long-term perspective, I'm not worried about IPOs and new companies coming to the market, especially when some of the macros in India are changing, some new sectors are emerging. It is logical that some of those will come to the market. Internet, ENS, so you will see more and more companies coming to the market in some of those sectors, green energy, etc. From a short-term perspective, yes, it does create an overhang, but I don't think we've seen that kind of, there have been flows which match these IPOs, right? And therefore, it's not creating an overall pressure on the market. That is not, to me, a major worry. It's good for the long term, and in the short term, the market is healthy enough to absorb these IPOs and create. And many of these are very high quality companies which are coming through. So I don't think that is a major worry, at least from my perspective.
Got that. Seshadri, hi. So how stretched are the mid and small cap valuations right now? Which are the pockets where you think there is a risk that overvaluations will need to get corrected? And where do you see some pockets of a reasonable risk reward right now?
Overall, I don't think mid and small cap are overstretched on valuations. The optical high numbers have many nuances to it. In summary, the mid and small cap, post-COVID, that entire universe has shown better growth than large caps, with stronger, with improving balance sheets. And I think that's something that's missed in the post-COVID world. Cash flows have improved, ROCs have improved, debt has gone down in the small and mid cap universe. So for them to be trading at slightly premium valuations is not a surprise. Moreover, it is also down to sectoral composition. We did a piece some time ago which pointed that out. The large cap universe is very heavy in some structurally low PE sectors like banks and energy. Whereas the large cap, the small and mid cap universe has a much smaller share of those sectors, which is why optically the valuations look easy. If you break it down and look at sectorally, there is not a case to be made that there is a large bubble building up there. In terms of where do we find value in terms of the large, and you're absolutely right. With the indexes trading in the 30s, there are pockets of overvaluation. So, as I said, when the valuation comfort goes, you've got to be more selective. Where we like small and mid caps, auto and auto ancillaries is one space where you're finding reasonable value. I think in that consumer discretionary space, you will find industrials is the other area where if you look hard enough, and especially the power ecosystem, there are plenty of opportunity for the small and mid cap. In some sectors like FMCG, which I'm structurally bearish on, value will be found in the small and mid cap space because that's where the market share gains are coming.
Interesting, bit of an anti-consensus call on the financials, Seshadri. I remember speaking to you about this the last time as well. You still continue to remain underweight on the sector. Is the NIMS compression worry the only factor behind why you remain underweight, or there are multiple other factors as well that keep you on the negative side when it comes to what is possibly pretty much a consensus bullish call on the street?
Near term, it is NIM compression for certain. There is a small worry I have that the street is underestimating the quantum of that NIM compression, and therefore you may see a little bit of earnings downgrades coming through in the short term. But my view is not based on that. My view is a more longer term structural view where the banking market cap is largely composed of private sector banks. And the large private sector banks have seen a structural fall in their growth rates. I've covered this sector from the beginning of the century, and we've defended 4 times price to book for some of these banks because they were growing at 25%. Now most of them are struggling to grow above mid-teens. And once your growth falls to that level, then it's difficult to sustain the high price to book. Admittedly, some of those price to books have fallen, but even a 2.5 time price to book is very difficult to be supported by just a 14-15% ROE when you're not even 14-15% growth when you're not even exceeding your ROE in terms of growth. Moreover, profitability is becoming more difficult to find. So it's a structural call. It's not just the names.
We get that point. Thank you so much for joining in with your insights, Seshadri. Always a pleasure speaking with you. That's the word coming in from Emkay on Indian market.